I'm going to show you exactly why commercial real estate prices have been falling that most people have been overlooking. Take a look. There are 5 parts that you need to understand. Part 1 is this. Let's assume that this building right here generates $200,000 a year of revenue when this building is fully occupied and all the tenants inside of the building pay rent. But you have expenses as the landlord. You have to pay your property taxes, your insurance, your maintenance, your management fees. So let's assume that your expenses as a landlord for this building are $100,000 a year. I'm going to use round numbers to keep this simple, which means your net operating income, your profit before paying for your mortgage is $100,000 a year. So now the question is, how much is this building worth? And this is where what real estate investors do is they apply a multiple to this number, to the net operating income. So if we apply a 20 times multiple, also known as a 5 cap for all the real estate investors, that means you take this number, your net operating income, multiply it by 20, and that gives us a valuation of $2 million. So now you want to buy this $2 million building and you say, okay, I don't have $2 million in my bank account, but I have some cash to put down as a down payment. I can put down 30% or $600,000, and then I'm going to finance the other $1.4 million. Now, if we back up a little bit and we assume that you can go out and get a 3.5% mortgage. I know that's not available today, but let's assume that you can for the sake of this video. You can get a 3.5% mortgage on your $1.4 million of financing. That means your mortgage costs are going to be around $76,000 a year. Now remember, you're making $100,000 a year after your expenses before your mortgage. Your mortgage payment are $76,000 a year, which means you have some margin. You're going to make about $24,000 every year after paying for all of your expenses, after paying for your mortgage, and then that $24,000 is what you get to keep in your pocket. But the problem that we're seeing today is you're not going to get a 3.5% mortgage. You're going to be getting something closer to that 7.5% mortgage. Which means now if you go out to finance that $1.4 million, you're not going to pay $76,000 a year. You're going to be paying $112,000 a year to borrow the same amount of money. Now you can see the problem. If you borrow that $1.4 million at 7.5% a year, you have to pay $112,000 just in your mortgage costs. But this building is only making $100,000 a year. That means if you were to buy this, you got to pay money out of your pocket every single month just to keep owning this building. Not a very good investment. And this is where now what an investor would say is, okay, I want to buy a building. You're making $100,000 a year, but I can't afford to pay you this 20 times multiple, this $2 million price because, well, I'm just not going to make any money. I'm going to have to lose money to purchase this property. Instead, what I can offer you, instead of a 20 times multiple, is a 14 times multiple. Instead of paying you $2 million, I will be willing to pay you $1.4 million. This is also known as a 7 cap for your real estate investors, that I will pay a 14 times multiple on this property, so I'll pay you $1.4 million. And this is where many sellers are saying, or were saying, no, I don't want to sell my $2 million property for $1.4 million, so I'm just not going to sell my property. I'll hold on to my property until things get better. Now, we did have some people that wanted to sell their properties over the last few years, but interestingly, you had a lot of cash buyers out there. That these cash buyers didn't care about this mortgage issue, so they would just come and pay that $2 million price, all cash, which is where sellers were happy because you had less inventory in the market, and then the sellers that were selling, they could get this all cash price so they didn't have to worry about these higher mortgage rates. And this brings us now to part 2, falling valuations. But before I talk about that, I want to take a quick minute to talk about our sponsor LMNT, because if you've ever struggled to stay hydrated like me, then you got to check out our sponsor LMNT. I work out pretty much every day, and so staying hydrated was very important to me because I knew that if I wasn't staying hydrated, I would get headaches and I just wouldn't feel good. Well, earlier this year, I purchased a big water bottle trying to keep myself hydrated, and I would drink more and more water, and I'd realize that even if I drank more water, I wasn't staying hydrated. In fact, I got more thirsty as I drank more water, and that's when I realized that it wasn't just the water that I was drinking, it was that I wasn't getting enough salt in my diet. And that's when I gave LMNT a shot. They're a 0-calorie electrolyte drink. They have 0 sugars, 0 artificial colors. I'm the one that reached out to LMNT for the sponsorship because I liked their product. I was using it myself, but the reason why I like it is because they add salt to your diet, and for those of you that want to stay hydrated, it tastes really good. All you gotta do is mix it with some water like this, and then you drink it, and you're done. So if you are active, or you're on a low carb diet and you want to optimize your sodium levels, you can give LMNT a try. The best part about LMNT not only is that it tastes good, but because you're watching the Minority Mindset show, you are going to get a free sample pack with 8 different flavors with any purchase that you make, just because you use my link down in the description below. Yes, Minority Mindset is a paid partner with LMNT, but if you want to learn more and optimize your nutrition, I got the link to how you can learn more and get your free sample pack with any purchase down in the description below. So now with part 2, valuations falling, this is where most people assume that the world is ending because this $2 million property dropped in value to $1.4 million. But what you have to remember is the falling valuations aren't a problem until they become a problem. Let's assume you buy a home for $2 million. You're living in this multi-million-dollar home, and then you go on Zillow and you find out that your home is only worth $1.4 million. Well, what does that mean? Again, it's not a problem unless it becomes a problem. Because if you can continue making your monthly payments on your mortgage, no big deal. If you paid off your home, no big deal. It's only a problem if you go to sell and you don't have enough equity in the property, or if you can't make the payments and now you can't sell the property. That's when this becomes a problem. And up until, well, not that recently, this has never really been a problem because no seller who didn't want to sell the property was being forced to sell their property. And this brings me to part 3. If you go out and you buy a commercial property like this, whether it's a retail building or an office building, you're not getting a 30-year fixed rate mortgage. You're getting a 3-year mortgage, a 5-year mortgage, maybe a 7-year mortgage. And so they're shorter term mortgages that readjust after the end of your loan. Well, in 2020 and 2021, every landlord who has debt refinanced their mortgage at 3%, 2%, 3.5% because mortgage rates were at their lowest levels ever. Well, remember what I just said a second ago. You don't get a 30-year fixed rate mortgage. You get 3-year mortgages, 5-year mortgages, and 7-year mortgages. And now what we're starting to see happen in 2024, and we'll see more in 2025 and again in 2026, is a lot of this debt is now beginning to readjust. And what you have to remember is that interest rates are a lot higher today than what they were just a few years ago. According to Bloomberg, we have about $1.5 trillion of commercial real estate debt that's about to readjust. Now the question here is this a problem? Well, normally what would happen in this situation in a normal economy is a landlord in this situation would say, okay, I own this property. I'm making $100,000 a year. I see that my debt costs are about to go up. I see that my debt costs are about to go to $112,000 a year, which means I have to raise the rent on my tenants. I have to raise the rent on my retail tenants. I have to raise the rent on my office tenants. Or if this is an apartment complex, I got to raise the rent on the people that are living in this property. But the problem is some of these people don't have the ability now to pay 20% higher rents because that means the landlord is going to have to make at least $120,000 a year, if not $130,000 or $140,000 a year to maintain some margin between paying off their debt and paying off their expenses and having some profit in the deal. But the problem is, well, a lot of these landlords are sitting on partially vacant buildings, especially if you're in the office sector. You can't go out and just start raising rents on your office tenants because you might be 20% vacant, 30% vacant, 40% vacant, 50% vacant. And if you start raising rents, you might end up 80% vacant. And so now what's ended up happening today is many landlords are actually not making this $100,000 a year. This was an ideal case situation. They're actually making $60,000 a year because a big chunk of this building is vacant. So now what's been happening is many of these landlords have been paying out of pocket or barely making any margins because they thought that things would turn around by now. But because we're starting to face this other hurdle, which is the debt readjustment cost, which is coming sooner and sooner and sooner, now many landlords are starting to see this pinch. Do I cut the price of my property and maybe lose money by selling the deal? Or do I continue hoping that something's going to turn around? Or do I go and raise rent on my tenants? And this brings me to the 4th part of the video, which is the dilemma that many landlords are in right now. And we just talked about how now landlords are having to decide between taking a price cut on the sales price or trying to figure out an alternative. And what we've been seeing happen is many landlords are now, instead of making their next mortgage payment, is they're just mailing the keys back to the bank. Take a look. This is from CoStar. Many properties are being surrendered through so-called deeds in lieu of foreclosure, which are voluntary, unlike regular foreclosures that involve an involuntary seizure, and the option is being mentioned frequently in financial filings. What that means is that a lot of larger real estate firms are now filing these deeds in lieu of foreclosure, which are essentially a voluntary foreclosure. Hey bank, instead of you coming to foreclose on my property, how about I just save you the time and money, you save me the time and money, and I just give you the keys, and now it's your problem. This is what we've been seeing more and more of, because a lot of landlords are saying, well, instead of having to sell this property for a price cut where I'm going to have to pay money at the closing table because I owe $1.7 million here, instead of having to deal with that, instead of having to go through a lengthy, painful, and just embarrassing foreclosure, how about I just give you the keys and now it's your problem? And for all of you visual learners, here's a chart. Between 2020 and 2022, we saw the steady decline of office owners surrendering their properties. But then in the second half of 2022, we saw office owners surrendering their properties at a much higher rate, and it's not slowing down. And this brings us now to number 5, which are the forced sales of properties. So now we go back to the situation. You bought this property. The property was supposed to be making $100,000 a year at a 20 times multiple, a 5 cap. This property would be worth $2 million. The problem is that nobody wants to buy your property for $2 million unless they have all cash, because if I took out debt to purchase your property for $2 million, I'm going to be losing money, and most landlords or new investors are not going to want to lose money every single month. So now, in order for you to sell this property, you'd have to take a price cut to $1.4 million, but you don't want to sell it for $1.4 million because then you're going to lose money. So now you have to decide, do I want to mail in the keys to the bank? But if you don't want to mail in the keys to the bank, what is the alternative? Because you also have your debt costs about to go up, because you know that either in 2024, 2025, or 2026, your debt might readjust. And if interest rates stay higher, well, then your costs are going to go a lot higher. And if your costs go higher, well, then you're not going to make any money. You're going to be losing money every single month, which means now, what do you do? But then you also have the handful of people that are in a situation where they're already losing money because they know that their debt costs are going up. But besides that, they're not making this $100,000 a year. They're only making $60,000 a year. And now they have to make the decision of, am I going to keep paying money out of my pocket every single month? And if I own a portfolio of properties, I might not be able to afford making these payments every single month just to maintain the property taxes, the insurance, the maintenance, the management, and then the mortgage fees on top of that, which is why commercial real estate foreclosures have been shooting up and up and up. This is a chart showing commercial real estate foreclosures, and while we're not at the peak of the 2008 crash of commercial real estate foreclosures, our trend is definitely upwards with these foreclosures. Now you might be saying, but Jaspreet, this is such an easy problem to solve. What if we just cut interest rates from 7.5% back to 3.5%? The Federal Reserve Bank cuts interest rates so mortgage rates go down. Now problem solved. Now sure, now you might be able to kick this can down the road because now these commercial landlords will be able to refinance, property values will be able to go up, but that creates another problem, which, as we all know, is inflation. Because when interest rates go down, what happens? Well, people spend more money. Right? People go out and shop. People go out and buy things. What are the things that they buy? Well, one of the things they buy are homes. They buy cars. And that might seem good for the economy, which it is, but that also creates the inflationary problem, because remember, inflation is when the value of our dollar drops, causing the price of things to go up. And the big battle that's going on right now is that inflation is outpacing wages. Now, that's not a new thing. That didn't just start after the pandemic. That has been happening for a while. But inflation has been outpacing wages at a very significant rate, which is why so many Americans are struggling a lot more today than they were a few years ago, because your rent is more expensive, groceries are more expensive, your costs to survive are more expensive, while your wages generally have not kept up for the average person. And this is where now, if you start cutting interest rates, and home prices start to shoot up even more because now you have more bidding wars. Car prices start to shoot up even more because people want to buy the limited amount of cars out there. That creates another problem. And this is where now the Federal Reserve Bank, we've been talking about this a lot on this channel and on market briefs, but the Federal Reserve Bank has been working very hard to try to walk this tightrope. They're trying to balance inflation with the economy. Now, on the economy, you can start to see the issues in the commercial real estate market. But on the inflation side, you can't bring inflation down without any sort of pain. And so this is where what you need to understand is you want to be looking for opportunities. And this might mean looking for opportunities in the real estate market. And if you don't want to go out and invest in real estate, well, you can also do this through the stock market by potentially looking for strong assets, strong companies that are taking advantage of this downturn in the commercial real estate market. Now, what's going to happen in 12 months? Nobody knows. I can't tell you what the Federal Reserve Bank is going to do. I'm not in the business of trying to predict what the Federal Reserve Bank is going to do. Do I have an opinion? Sure. Everybody has an opinion. No human doesn't. But what I want you to do is understand the shifts that are happening in the economy. That way you can take advantage of shifts that are happening in the economy, because at the same time, the reality is shifts in the economy create opportunities for those who are financially educated and those who are prepared. And this office downturn is going to hurt people. It's going to cost people a lot of money. Some landlords are going to lose a lot of money. Some banks are going to fail because of this, but it's also going to make some people a lot of money. And if you can find the right opportunity, that will give you the opportunity to build wealth through this downturn. But that requires you to understand what's happening, but also be prepared, meaning have cash aside that we can capitalize on opportunities that might come your way. Commercial foreclosures sank during the pandemic, but over the last 12 months, we've been seeing this steady rise in commercial real estate foreclosures. If foreclosure doesn't just mean that a landlord is running out of money, it also means that a bank isn't getting paid. Banks are having to write off these bad loans, putting more stress on the banking sector at a time where the banking sector was already struggling.